all our guests are there for you to see. We're joined by Soumyakanti Ghosh right now and also Mr. Unnikrishnan. Thank you so much for joining us right now. But let me go to Madan first. I heard someone say that, are you satisfied with the guidance that the RBI is giving? That was a question to Governor Rajan, and he I didn't quite understand that question, but I think Mr. Chaudhary explained that the guidance, has it worked out? One of the things that struck me, and someone in the past had called him a hawk in dove's clothing. Every time what you see on print, he comes out and then tries to soften the blow a little bit. That 7% modeling, the RBI's model says that they'll reach 7%, but he says subjective analysis shows that we'll reach 6%. Do you buy that?
No, actually a number like 6% to my mind is going to be a very tough target, because if you look at our past, I think probably 2003, 2004 was probably the last time when we had a CPI inflation number of 6%. Of course, it was a different index. We have a new index, but broadly they move together. So actually putting something like 6%, okay, we may probably reach it at one point of time, but to retain it and maintain it at 6%, I think we're sort of tying our hands tight. Yeah? So I think there will be a lot of work for the RBI to do as to what happens in case we don't reach 6, or after 6 I go up to 6.5%, 7%. Does that mean that automatically interest rates have to increase? Or is it a one-case affair which we're talking of? So I think this is the thing which we are also talking of. Well, I think Prashant and I, we were talking about it, about when you're going into CPI rather than the WPI, and we're putting a target of 6%, however it goes, whether it goes by a model or you're putting some kind of inflation targeting, which may not really be very practical or realistic on a sustained basis. There could be an issue in terms of how we really conjecture RBI policy is going to be geared in the coming years.
All right, Mr. Manian, I understand you have to leave, so I'm going to go to you first. What did you make of, I know you have to leave, so I'm going to get a general question from you first before we go back to that inflation issue. What did you make of Governor Rajan's clarifications?
Yeah, like we expected, it was to be a status quo kind of a situation on the interest rates. In fact, I would say he has made a slightly more hawkish statement than expected on bringing this 6% issue, because most of the market was still looking at the near-term target of 8% and hoping that that will drive the policy from here. But clearly his emphasis on the 6%, I would generally read it as more hawkish than expected by the market.
All right, sir. Thank you so much for joining us. I understand that you have to go for a meeting. Thanks a lot. We'll have you back soon when you have more time. Mr. Unnikrishnan of Thermax is there with us. I'm going to go to you, Mr. Unnikrishnan, in a short while. Stay with us. I want to ask Mr. Chaudhary, when you have a model which tells you that your inflation is going to be 7%, what meaning does it have to say that the model says 7%, but we think it's going to be 6%, and therefore don't worry, we are not going to raise interest rates?
No, not particularly. Model is, putting into numbers the thoughts that you have. But what I find very surprising and very different from all central banks, there is no mention of the decelerating industrial production numbers.
Yeah.
So all central banks in their, discussion or in their projections always comment, whether optimistically or not so hopefully, on the state of the economy and particularly the job market and the growth. But surprisingly in this, none of these calculations find any place in the RBI policy, and it is a single-minded inflation fighting. But what happens to the person on the street, and particularly the example that you are giving, that the friend of yours lost jobs. The people lose jobs because companies downsize. The companies scale down their operation, close down, or do not undertake expansion. Now, what happens to that? Does the central bank or the monetary policy authority have no responsibility towards that? That's my question.
But Mr. Rajan can actually say, I have done it in the past. Banks have not responded. If there's excess liquidity, if there is money that the banks have with them, which they're parking in SLR beyond what they need to, then why don't they lend at lower rates? Why can't banks do that? Why does the central bank have to do it?
Banks can lend the lower rates by 25 or 50 basis points. It is like saying, 5 years back, the planes were running empty. and somebody says that I have put in the planes, why aren't the people traveling? But again, demand is a function of price. So therefore, why is the entire industry, now banks can't lend in air, there have to be applicants, there have to be entrepreneurs wanting that loan. So why is corporate India or general India not investing in capex? Are they not put off? Maybe it's a conjecture. Are they not put off by the higher interest rate? This is a conjecture, and I find no discussion on that. Either
Mr.
way.
Dayal here says that actually capex is not a problem. The problem is capacity utilization. I mean, no amount of loans is going to actually help utilize capacity if there's no demand.
Because if you are running at 70% capacity, but if you think in the next few years, the capacity, the product requirement would be much higher, you start addition to the capacity right then. Because capacity addition does not happen overnight. It requires a lot of planning and projection and a lot of preparation.
Okay, on that note, I just want to bring in Mr. Unnikrishnan, who's there with us, the man who will have to do that capacity expansion. Yeah, that's exactly what I want to ask him. Mr. Unnikrishnan, lower interest rates, will that make you increase capacity?
Not really as a singular indicator. For example, if the interest rate were to be brought down to say hypothetically 8% for lending in India right now, will there be a sporadic action in the ground in terms of a lot more capacity getting added? No is an answer. But that is one of the contributors. Like Mr. Chowdhury mentioned about capacity utilization is a fundamental thing for anybody to be looking forward to capacity expansion. Majority of the industry in the country, barring a sector, certain sectors, the core sectors are currently running at lower capacity utilization. For example, cement is at 65 to 70% across the country. Steel is running at 70% capacity utilization. Of course, oil and gas is almost at the brim. Power, of course, there may be shortage of capacity, but there is no offtake for electricity produced because there is no tariff compatibility between what is being paid and what is being spent for producing electricity. So these core sectors would take a much longer time for whether interest rate is brought down or not. The capacity utilization is much. However, which are the sectors where you can see impetus happening? For example, food processing, pharma, liquor, beverages, all this industry, textiles for that matter, there is nothing to do with the policy regulation of the country. It is fundamentally the consumption orientation. So the sentiments being negative, inflation having overtaken the purchasing power capacity of the individuals has brought down the consumption in the country. So that is an area where the sentiments are going to play a role. People will start buying. Once they start buying, certainly there will be a capacity utilization happening in this area. And these are normally short-term cycle projects. You're talking about maybe a 12 to 18 month cycle time for a project. So I would see a lot more of traction happening in unregulated, non-regulated industries, and which is already seen on the ground level by us.
But what can the governor really do about that? What can the RBI do? I mean, no one takes loans to buy textiles, for instance. I mean, you can't really push demand in that kind of consumption by lowering interest rates. I'm not going to buy cheese, food processing. I'm not going to buy cheese by taking a loan from a bank.
Well, I agree with you. As an industry, they may not be looking forward to, though it can be one of the positives. For example, let me tell you, when the banks are plumb with money today, they have extra money available with them. If they were to be bringing down the interest rates by maybe a 1.5 to 2%, up to 200 basis points, it can certainly be making some projects which are on the borderline of viability and unviability. For example, if an IRR of a project currently is say maybe at the rate of say 17 to 18%, at 12.5% lending rate for a B category industry, he will have a spread available of 3.5 to 4%. Why would anybody want to take a risk of a 4% spread and invest for that? Whereas if there is a spread of maybe 8% available, that is 10 is interest rates and 17.5% is IRR available on a project, at 7.5% I don't bother for what's happening, whether the GDP will grow by 5.5%, 6%, 7%. I do know that majority of my money is coming from the bank because the equity component is going to be 25%. 75% is going to be given by the bank at a rate of 10%. So my overall cost of capital is going to be coming down. So I would rather invest at this point of time. So there is a point in that, but those are not the larger projects. The larger projects will have to depend a lot more on the policy regime which is going to be existing in the country, where there is a lot of positive feelings in the market right now. I mean, if you talk to anybody who's an investor, I'm talking about industrial investor, the CEO of a company,
right? That's what you're saying.
owner of a company, nobody is talking negative. Nobody is talking negative.
Yeah, the mood is upbeat, very buoyant. Mr. R Sivakumar, head of fixed income at Axis Mutual Fund, is also joining into the discussion. Mr. Sivakumar, thanks very much for coming in. What did you make of the policy? You heard the governor as well. What's your sense?
This is a very balanced policy. In many ways, the RBI is a lot less hawkish than many, I think, on your panel have been saying. For one, very clear acknowledgement.
A lot less hawkish?
Oh, a lot less hawkish.
Okay.
For one, over the last two policy statements, from June to the August to today, you've seen the RBI go from inflation projection bias on the upside to balance, and now acknowledging that inflation is significantly, or the balance of risk on inflation.
Exactly. Let's just actually put that up. The key, operative portion of the policy stance up, that graphic up. And I just want to read it out very quickly, because I think this is the one line which was perceived to be negative, right? Hawkish. If we have it, we could sort of do it now. The future policy stance, and I'm sort of reading verbatim here, the future policy stance will be influenced by RBI's projections of inflation relative to the medium-term objective, which is 6% by January 2016, while being contingent on incoming data. So they're not actually bothering about 8% by Jan 2015. They're saying, our objective is inflation getting somewhere close to 6% by Jan 2016. How is this less hawkish?
There are two pieces here. One is, even for the 6% inflation for next year, in the August policy, they were saying that the risks are substantially on the upside. And now they're saying those risks have reduced, which is to say that they are now a lot more confident about hitting the 6% inflation target in Jan 2016 compared to where they were 2 months ago. What we have received in the last couple of months is incremental data on CPI inflation, which suggests that the momentum of CPI inflation is right now at about 6.5% on the headline basis and at about 6% on core basis, which is to say that your core inflation has already reached your next year's target of 6% and your headline inflation is almost there, well at 6.5%, which used to be in double digits last year. So you've seen a substantial moderation of inflation. We are talking about CPI.
No, CPI, what was the last print? CPI was 7.8. Yeah.
But you need to understand that when you look at the seasonally adjusted annual rate instead of the YOY, so which is the point I think they have also made in the accompanying monetary policy report, that you need to look at the additions on a month-on-month basis and then the base effect. So what they call the momentum and the base effect. The momentum of inflation suggests that inflation numbers have moderated probably to about 6.5%.
Policy sounds even more hawkish, because then they should have acknowledged it.
There is an acknowledgement, which I think is a recognition that the forward risks on inflation have come off sharply. Right. The fact is, those risks are probably not receded enough for them to cut rates today or to give a guidance on a rate cut.
In the same policy stance, it says balance of risk on upside for medium-term 6% inflation target.
So the language
Balance of risk is on the upside for midterm.
As a lot more hawkish in August. So the point I'm trying to make is, from August to today, the language is a bit is slightly more, and I think there's a recognition that incremental data is a lot softer than the headline number were to suggest.
Okay, all right. There are a couple of other things which I just like to quickly put out. So this is from the policy sort of statement, longer than usual, and maybe we can just quickly put this out. So the RBI's thoughts on lower credit demand. So credit demand fell below 10% recently. They're saying sharp fall in loan growth partly on account of high base. Adjusting for base, loan growth would have been about 11%. Corporates also access the commercial paper market. That's one reason. Sale of stressed loans to ARCs don't show up as bank credit. On public sector banks, there is a separate para which says slowdown in loan growth more pronounced in PSU banks, and they're wondering aloud in the statement as to whether balance sheet restructuring, repayment of stressed loans, higher risk aversion are also factors which have contributed to very low credit growth as far as PSU banks go. And there's a question mark there. They're not saying these are responsible. They're saying these could be factors which are responsible. There's a warning to corporates. They say, well, liquidity conditions have eased for Indian corporates globally as well, but corporates should be wary of being lulled by the relative exchange rate stability. Don't neglect to hedge foreign exchange liabilities. So it's a This is not this one, but RBI wants corporates, that one. And then there is, a few other things as well. Early warning system, norms for entities to be called non-cooperative. Those are going to be out by the end of October. So those are things which have also been done. Madan, just to take off from what Mr. Sivakumar said, would you say this is less hawkish than the previous policy? What would be your reading? And the momentum which he referred to?
No, actually, Prashant, I wouldn't be using terms like hawkish. I think we always say whether it's hawkish or dovish, but the fact remains that inflationary potential is still high in the country, because I think the main reason why the CPI inflation number was high was on account of food inflation. Ministry of Agriculture has already stated that Kharif crop will be lower than what it was last year. There are going to be pressure points in terms of prices. So whichever way we look at it, there is high inflationary potential, and I think that's the main reason why the governor has chosen not to really take any action on interest rates. And the statement put forward to my mind is more of a standardized statement. I think we could always debate whether he's more hawkish or less hawkish, but the fact remains that there is inflationary potential, and it's something which is going to remain with us, given the fact that if food inflation is the major concern, we are terribly dependent on the monsoons every year. So we're going to have the same situation even last year. In case there's any kind of a shortfall in the monsoon, there's going to be inflationary pressure.
Munish, this SLR holding under HTM, held to maturity, being brought down eventually to 22% from current 24%. How would this impact earnings for banks?
So depending on their bond portfolios, they'll have to mark-to-market the AFS portfolio. So, for some banks, this could mean some profits for the others who have bought them at different rates. So it would have a direct impact on the P&L. And the fact that the RBI is doing this gradually, there is an expectation that rates will come down on the 10-year from 8.4 more towards 8%. And that would directly impact the holding on this portfolio to the P&L.
I just want to understand, Mr. Dayal, this HTM, is it a limit or it's a requirement, minimum requirements?
So the minimum, so the banks have an option of defining how much they want to hold for HTM, and they have limited it now to 24%.
So in the sense that if you're limiting it to 24%, and people were saying that if it brings down to 22%, it's actually good, right?
Yes, it basically means that part of your portfolio, as the interest rates moved, you'll be able to mark-to-market those portfolios.
No, but let's say a bank holds government securities, right? And that is what the SLR contains. And the reason why they wanted HTM is because it's something which has been imposed on them, and they don't want movements to be booked every time.
So during the phase when the rates were going up, the prices of the bonds were coming down. And had they not decided to hold them to maturity, they would have to book losses. Right? So they conveniently park them as held to maturity, in which case you don't have to hit the P&L. Now, as soon as they expect the rates to come down, and if they have a portfolio which is in the AFS portfolio, and the interest rates fall means price of bonds go up, they'll be able to sell on a profit.
Now, the question that I have is that when you reduce the held to maturity, right? Effectively, you're saying that then any excess SLR can be taken off? Yes, I mean, you need to essentially. Yeah. Actually, you can't because 2%. Effectively, then the demand for government bonds should reduce. If that happens, why shouldn't yield go up?
So you're allowed, means you have a larger part of your portfolio which you can trade in. Right? And that means you will encourage trading in those bonds and will effectively price your bonds according to which you can buy and sell. But during the regime which was a fairly long time when rates were going up, banks just parked almost everything in HTM.
But also, wasn't that one of the reasons why government bonds are expensive? I mean, they're priced high. When you reduce the demand for government bonds, I know you're saying that when it's traded, it's going to be priced adequately, but when you reduce the demand for government bonds by force, you're telling them you can't have this much under HTM, so reduce 2%. If you're going to do that, the demand for government bonds goes down. And effectively, when the price goes down, yield should go up. I mean, that's what we saw last time.
And that should happen. And I think that should play out.
Right? So then there's a problem in terms of the P&L, right? So effectively, yield, we were talking earlier, a 10% drop in yield has a 10% increase in ROE. So while your P&L basis you have a gain, your ROE tends to go down if the yield rises.
Yeah, so it would, but the banks today, if you look at the banking system right now, they have a problem in providing for, so they have a profitability problem.
Yeah.
If you look at the PSU
Right, fair.
banks as a set, which is 70% of Indian banking, they are running at an ROA of 0.6%. Their ROE is 10%.
Yeah.
And their provisioning now is so high that about 10% of the assets of PSU banks are NPL plus stressed, which is about 30% of their net worth. Now, with incremental provisioning coming in, either through either coal issues, etc., and they've not really tackled they've not recognized all the problems. They have a profitability issue. So this may be a breather for some of them to actually get profits in because they have to provide for this NPL.
Right.
Remember that these banks, the public sector banks, over the next 3 years need estimated to about $37 billion of tier 1 capital. Okay. Incremental. Now that's a huge sum of money for a bank which is not profitable, has low ROAs, low ROEs, and inability to raise capital in the market. So the issue is that these are small things which will happen. But if credit had really picked up, had credit gone up to 18%, who would fund it?
Yeah.
Right? Where is the balance sheet in the country when you have a reasonably bankrupt banking system on the PSU side? Where is that funding going to come from? So you have a clutch of private sector banks which are doing well, and all their ratios are much better than PSU banks. So that's an issue, and I don't believe the governors addressed that in so many words.
Mr. Sivakumar wanted to come in on this particular point, and you want to sort of talk about the LCR, right? The liquidity coverage ratio. Yeah.
I think it's very important to look at the context of the SLR cut or HTM cut in the context of the incoming norms for Basel III, which is the liquidity coverage ratio or the LCR. Banks have to maintain a minimum LCR going forward, and the eligible securities for LCR, a substantial part of that would be G-Secs held over and above the minimum SLR requirement. So let me illustrate this. For example, if a bank has 100 rupees of SLR securities, but 80 rupees of which have to be maintained for SLR statutory requirement, then only the incremental 20 is available for liquidity coverage. So what RBI is doing by reducing the SLR norms, let's say from 80 to 70, is to allow banks to hold more securities under the liquidity coverage rather than for the statutory liquidity ratio. This LCR norms kick in from Jan 2015. So a lot of the steps that they have done in terms of reducing SLR is to actually prevent a scramble for G-Secs. That is to say, if they had held the SLR at the same level and then held the SLR at the same level and kicked in the LCR, banks would have been forced to go into the market to buy more G-Secs for LCR. By reducing the SLR, they're freeing up G-Secs, which goes towards LCR. So the total demand for G-Secs is not expected to come down as a result of these changes to SLR or HTM.
Can just use that 100 rupee example again for us and for our viewers.
Let me quickly. So I won't use 100 rupees because let me just use the numbers which are roughly where in the market. So out of 100 rupees of total bank balance sheet, about 30 rupees is held in government securities. Out of that 30 rupees, historically, let's say 25 rupees was SLR and 5% was free. Now, incrementally going forward, if the SLR comes down, for example, from 25 to 22 over a period of time, then anything above 22 is free. And if they continue to maintain 30, that means 8 becomes free. And incrementally from Jan 2015 all the way to 2019, the LCR norm kicks in. So incrementally for the next 3 to 4 years, you will see banks maintaining higher component of G-Secs towards liquidity coverage ratio. And
what did you exactly mean by free, 5% free, and if it comes down to 22%, 8% free, you mean that can be reduced whenever the banks want?
No, it's not a question of when the banks want. Banks need to maintain a certain percentage of LCR. So today, they have 5% available. That 5% becomes 8%, which is to say that a higher amount of securities is available for liquidity coverage. And since these liquidity coverage ratios are kicking in from Jan 2015, it's imperative that the RBI takes steps in tune with the rollout of Basel III to reduce SLR. Because otherwise, banks have to maintain the current level of SLR and then go and buy more G-Secs to cover for LCR.
So, Sivakumar, you're saying, say for example, if it gets cut from 25 to 22, 8%, right? From 5 goes to 8. That 8 will be, again, government securities primarily.
Today we are talking about, so the eligible securities for LCR, a substantial part of that will be government securities. They also allow some corporate bonds and
those
even
can be traded, or those have to be held till maturity?
what's called high quality liquid assets, HQLA in the Basel terminology, which is to say that they need to be very liquid assets. So government securities are one such asset. They have also classified certain other securities, for example, some corporate bonds and some even equity shares which can be held for LCR. But the larger component of LCR will be government securities.
It has to be government.
It has to be government.
And what is the, for LCR norms from 2015, what is the percentage which has been specified?
LCR effectively means that banks have to maintain liquidity to the extent of 30 days of cash outflows. So they have to model on their own balance sheets how much expected outflows are going to happen in the next 30 days on a model basis, and maintain enough liquidity to ensure that if the markets, if a Lehman moment happens again and the markets shut down, that they have liquidity for the next 30 days. So this basically means that banks have to calculate, each bank has to calculate its own liquidity needs and provide security against that.
What's your view on the GSEC market, Sivakumar? Do you think we are, yields were 9, they've come off a little bit. Do you think it's going to essentially go down from here?
Yes, I think the big point is that we need to look at how real rates evolve. Our expectation is that your real rates in India for GSEC should be about 1 to 1.5%, which is to say that if inflation drops as RBI expects to 6.5%, then your 10-year GSEC should be trading in the 7% handle rather than the 8+% handle that we are today. So we expect the GSEC yields to drop quite sharply over the next 12 to 24 months.
24 or 12?
12 to 24 months. That is, over the next year.
If we again go stick with the 6% threshold for cutting rates, that's only Jan 2016. Right? And they're not looking at momentum. We're talking about headline numbers here.
I agree. The evidence suggests, though, that the bond markets won't wait for RBI. For example, in January of 2013, when the first rate cut happened, when you moved from 8% to 7.75, your 10-year GSEC rallied to 7.75 before the RBI cut, which is to say the market anticipates a rate cut and rallies. The same can be observed a year before that, April 2012, when you got the rate cut from 8.5 to 8%, 50 basis points rate cut. Even with the overnight rates at 8.5, your 10-year GSEC was trading at 8.30. So basically the curve inverts. If the RBI gets late to cut rates, then the markets will rally ahead of the RBI. So I think the bond markets are not going to wait. The bond markets will react on incoming inflation numbers. If inflation numbers are trending towards that 6.5% band, you will see the bond markets rally quite sharply.
All right, Saumakant Ghosh is also there with us. Mr. Ghosh, you heard what the governor said. Their modeling suggests a 7%, but they subjectively feel it's going to be closer to 6% number. Do you agree with that?
See, as per as if you leave aside that model forecast for the time being, and if you look at the fan chart clearly shows that the risk which were there in the August policy has now subsided to on the downside. So I think that's the positive part of the statement which I read into. And the other thing is that which is clear in this case in the terms of the policy is that the policy statement is now clearly saying that the 8% target for January will be achieved. There is a little bit of worry regarding the 6% target. We all have a worry of reaching the 6% target in January 2016. So that was nothing new. But the good point is that as of now, the policy is saying that the risks which were there in the August policy may have somehow declined. So I think that's a positive part from the policy statement, and overall it has been a balanced policy, and specifically the suggestions of cutting the HTM to 22% and giving it about a calendar shows that the RBI is now more concerned about making the HTM SLR and the excess SLR on a common platform. Otherwise it will not be an effective one. The another good thing which has happened in the policy, which has been mentioned in the last, is that the central bank has also given out guidelines of trying to see whether the bills and payment system from the medium and small enterprises is resolved by setting up a platform. I think that's a very positive step, because at the end of the day there is always issues of payments to these medium and small enterprises. So overall it's a good policy, and it agrees with the market consensus that the economy is firmly on a disinflationary trend, and we should not look into any rate cut or something like that, at least for the next 1 year or so.
All right, let's just try to recap what is, not just what the governor is saying, but what the issues are at hand. The number one is that we are in the middle of relatively high interest rates. Credit offtake is low. It's slowing down. It's not growing at all. Capacity utilization is low. Demand is not so high that people would start utilizing capacity. Mr. Unnikrishnan is still with us. Mr. Unnikrishnan, we were talking about the fact that is there going to be capex? You said no. Capacity utilization has to go up first. Now, who's going to blink first? In the sense that if you do not hire more people, there's not going to be more, more demand for goods. If there's no more demand for consumer goods, there's not going to be any demand for things that you build. Now, who's going to blink first? Who has to do that?
Well, the consumer, end of the day, he is a king. He is going to. So why do you need to have capacity? There are two types of capacity creations. One is the infrastructure-oriented projects, which are the roads, the ports, the airports, the rail, the equivalent of that. Those are to be initiated by the government. So I would believe that the government has got a primary duty to start the engine and start moving the engine, and the bogies will get added on through industry thereafterwards. So I would expect the government to be initiating a lot more of projects than what in the recent talks that they had been doing. I would want on the ground level more projects announced and taken forward. And there are public sector undertakings in the oil and gas industry and steel industry where they're sitting on pile of money. Today with diesel virtually market level pricing happening, the balance sheets of oil companies are also protected. With that, our expectation is let there be expansion in oil and gas, fertilizer which is controlled by the government, railways controlled by the government, defense expenses. Put together will be the starting point number one. Thereafterwards, automatically you will see more roads getting constructed, means cement consumption will go up, steel consumption will go up, and certainly then steel industry will start investing, cement industry will start investing. Let automobile pick up, then the conventional steel, HR coils will start moving up. These are the kind of things the government can lead a growth trajectory.
When counting was on, you were sitting in the studio, I remember, and you said that you're not looking for government to spend. You're just waiting for government to come in and do a little bit of governance, clear projects on the ground. People are ready to invest. Projects are stuck, and that is why, you are a company like yours is facing problems. Today you're saying is that is not really that much of a problem. Governance is not enough. You need government back in the economy.
Absolutely right. In the areas where, because you're talking about an engine which virtually stopped, and a traction to be given, the lead has to be given by the governance. Let me be very open. Sentiments on the ground are absolutely positive. I've not heard a single person talking negative. But beyond the rhetoric, beyond the verbosity,
as positive as it was in May,
happening, where the government has got to take a lead. No, it is far superior. Let me say the sentiments are far superior than May as of today.
We heard from Mr. Unnikrishnan, the man who actually has to spend the money and take those investment decisions while we discuss them on the ground. Madan, the question of course is that what can the RBI really do in a situation like this? When you target inflation, you're effectively targeting inflation by reducing demand, right? You're saying that I don't want credit demand to go up because that credit demand is going to create a bubble and a demand for goods based on that bubble. Right now, we have a problem with demand. Where is the bubble?
No, in fact, I think I've always maintained that ever since RBI started targeting CPI as that inflation target, monetary policy is more a case of a reaction to inflation numbers, the CPI inflation number, rather than a factor which could actually influence the CPI number. Because if you look at most of the components of CPI, I don't think any of them are actually leveraged. Maybe not more than 10% of the CPI weightage would actually be something which is based on leverage. So therefore, higher interest rates on its own will not be able to influence the components of the CPI. But this said, I think given the fact that financial savings in the country have been taking a beating in the last couple of years, I think it's a prudent policy to ensure that we have positive real interest rates. So therefore, when you're talking of positive real interest rates, definitely we need to have monetary policy calibrated to whatever the CPI inflation number is. Otherwise, ideally what we were doing in the past is something which I would go with when we are talking of if at all there are any excess demand forces which could be curbed by a monetary policy. It was the WPI, which is closer to a producer's index, which could have been used.
You know, effectively what you do, and I think in the break I was discussing with Mr. Dayal, at the end of the day, a person like Mr. Unnikrishnan will only invest if there's demand. If he's going to make profits on what he's investing, and for that he needs people to buy his goods, whether it's the government, whether it's producers, whether it's consumers, someone has to buy it. And what the RBI or anyone does is effectively target that demand. Mr. Dayal, you were talking about inflation being the main cause of reduced demand, right? But at the end of the day, how can the RBI control inflation except by targeting the demand, excess demand?
So, like we discussed, I think the two aspects to this is, one is high inflation creates lower disposable income. Lower disposable income actually impairs demand, and lower demand then means you don't have to put in any capacity creation. So as you increase the money in the hands of the consumer, you will have larger demand. I think the governments have over the last maybe couple of years.
But this assumes, I'm sorry to interrupt you, this kind of assumes that there's a disjunction between those who consume and those who produce, because at the end of the day, the people who are being employed by companies or by the government are the final consumers. So when you make it tougher for companies to employ people, then effectively what you're doing is you're leading to reduced consumption and therefore lower inflation. It's not as if inflation will increase consumption.
So in some aspects it actually will. If you had more disposable in your hand, you would consume more. Saying what I'm saying is, I think it's very clear to everybody that...
But I'm going to only have more disposable income if someone employs me, gives me that money.
Absolutely.
If they have to sack me because their interest costs are too high.
But it's a vicious cycle.
Yeah.
If you don't have money to spend, you won't have consumption, you won't have demand, and hence you won't have the corporate itself. So that's one chain of events which needs to play out. I think it's very clear that inflation is not being controlled only by the monetary policy. The inflation is a supply side problem. Okay. The supply side problem has been led due to structural deficiencies in the supply chain, whether it's on the food side or it is on the storage side, that India is deficient, right? And that is one of the bigger causes of inflation in this country. The second thing which the government has done, and that was the point I was coming to, that they have been putting money in the hands of the rural consumer. So whether it's through your minimum support price or NREGA or whichever government policies, they've been putting disposable income in the hands of a rural consumer who's been then generating that demand, and now they're trying to make it through an economic manner. So these are two economic things they're trying to sort. The third thing is that, and coming back to when credit will go up and when capacity will be created, I think the biggest issue, and we've not spoken about it, is that the country had a paralysis in policy making. The level of corruption at all levels across the administration was at its all-time high, and hence nobody was willing to invest in the country, existing people within the country or outside, because it could not get you an economic return. And what we see is the beginning of, or an intent of the government to try and sort some of these issues. Is it a magic wand which can sort this problem in 1 quarter or 2 quarters? The answer is clearly no. But is it an intent of the government to say, we are resolving these issues one by one, we are inviting you to come and invest, and you've heard the Prime Minister go and say, make it in India, etc., etc. But I think those are steps which are trying to at least do away with all the problems we were in. And that is what is going to create demand. And as that demand comes up, you will have a credit pickup. As you have a credit pickup, today the banks are flushed with money. The banks don't need liquidity, right? And if you see the calendar utilization by corporate India, they have used 35% less from the banks, but they have raised money on their own. Okay, increased by 35 to 40% from commercial paper and NCDs in the rupee market, which are all sub 10%. So the banks are stuck at 10.10 and 10 and a quarter as their prime lending rate or a base rate, lending at 11%. I think the market's clearing much below that.
So would you agree that banks need to do what the governor has already done what he can? Banks have the leeway to do it and they've not done it.
And they should, but their balance sheets are so impaired.
Yeah.
So you have a little problem over there, but the fact is that incrementally for the short run, for the short tenor, less than 1 year, the market is clearing sub 10. Okay, so there is a substitution going on.
All right, Mr. Ghosh, you know, historically there have been two ways in which you can, give a stimulus to growth. One is, of course, fiscal deficits, where the governments come in, state comes in, spends, gives a stimulus to growth. Once that has stopped globally, what has happened is easy liquidity, easy money has given that stimulus. Now it seems that we are crushed from both sides. The RBI is not going to give you that, and the government has fixed its target on 4.1. How do you get out of it?
See, at the end of the day, I think both of them are required for stimulating growth in the long run. If you want to put the causation in the reverse manner, a lower amount of fiscal deficit will put more money in the hands of the private sector, and that will actually another way of stimulating the credit demand. The other way to look into is that right now what is happening is that, I mean, the credit growth has significantly declined. But a good thing to the decline in the credit demand, if you look into it, that a lot of these corporates are now looking at alternate source of mobilizing the amount. For example, given the stock market has been a lot more buoyant this year, there has been a significant mobilization through a QIP route, and there has been also been some element of this deleveraging by the corporates, and also the borrowings has been on the lower side because the oil marketing companies, as the RBI policy state, has not been borrowing. So taking all these factors into account, I think even a lower credit growth at this point of time should not be taken as a cause for worry, because when you get onto the next phase of growth, the quality of growth will be much better. So my point is
so
that
this is a cleaning up process.
Too much into the data. Yes, the credit demand is suppressed, but I am confident. Yeah, I am more bothered about when we are moving on to the next phase of the business cycle.